Hello and welcome to a brand new show of Market Makers. I'm Nikunj Dalmia. Now the year 2016 needs no introduction. It's been a year of twists and turns and peak and turfs. It's been very difficult to judge and prejudge the market action. Whereas benchmark indices have not given a very handsome return, metal stocks have made a comeback, but individual stocks, they continue to chug along very smartly. Mid-cap indices for the year 2016 still have given double-digit return. So this market is becoming more like a stock pickers market. And will this trend of stock picking roll over to 2017 as well? What are the trends which could differentiate 2017 from 2016? And where is value in this market? Investing is all about buying gold at the price of silver. So where are the bargains in this market? Let's discuss all that and much more with a very special guest, Samit Vartak of SageOne Investment Advisors. It's your first time on ET Now, so very warm welcome and thank you for joining us.
Pleasure to be here.
The way you invest is that you don't look at macro, you look at individual stocks. The way you value companies is that you look at what is cheap. So I won't get into the macro analysis because you would like to give it a pass and I also want to give it a pass. Let's talk about where we stand in terms of valuations and earnings.
So, see, you got to have some benchmark for valuations. So for me, I've done analysis from 2002, okay. So if you look at 2002, so valuations can't be judged based on just the PE multiples.
Yep.
You got to look at where the economic cycle is. If you look at 2002, we were trading at almost the bottom net margins. The net margins have ranged from 4.5% to about 10%. In 2002, we were trading at around 5.5%, and the PE multiples were in single digit. So around 8 to 9 times. Now, if you look at against 2008, the net margins were 10%. At the same time, the P multiple were 26%. So what it tells us is that the contraction of P multiple is a risk. At the same time, the contraction of net margins is a risk.
You're making a case that Indian markets are expensive, to put it very simply.
Yes, I mean, you look at now. So if you look at the PE multiples, they're probably closer to the 2008. So, they're, if leave out the Nifty 50, but if you look at the remaining companies, the valuations are more than 25 times, trailing multiples. The comforting factor is that the net margins are also closer to the 2003 levels, which is 5.5%. So at least from a downside protection perspective, we don't see much contraction in the margins. What we would see probably is just the contraction in the P multiples. And so I think that's where the risk is. And that's where I think the valuations are little above where, for me, the comfort level is.
Now, what drives the market in the short-term sentiment?
Yes.
In the medium-term liquidity, long-term earnings. So I'm going to address all the aspects with you one by one. Let's talk about the market sentiment. The sentiment for equities is not bearish. Flows are strong. Domestic and institutional investors, they continue to buy. So optically, we may have corrected 10% or 12% from the recent high, but the participation is not bad.
Yes, I mean, again, I'll throw some statistics at you. You just look at since September 2013, when Prime Minister Modi was elected the candidate for BJP. If you just divide the top 1700 companies, into top 100 versus the next 400 and then the rest. The top 100 companies, the valuations have doubled, okay? And at the same time, if you look at the earnings, they're almost flat. But now come to the next 400 companies. Those companies have gone up 2.5x. 2.5x. It's not a small return. Whereas the earnings have contracted. And if you look at the bottom 1,000 companies or the 1,200 companies out of the 1,700, they have gone up 4x, whereas their earnings have almost halved. So that's the kind of indication of froth in the market. So it's not in the large caps, it's not in the top 100, but it's in the remaining companies, where I think what has happened in the last 3 years is that the higher the risk you have taken, the more money you have made. And that sort of gives you a false comfort. Not many people have lost much money. I mean, they're having contractions in the last 7-8 years, since 2008, but those have lasted for a very short period, even though they're having contractions of 20-25%, but those periods are very short and people have recovered most of the money they have lost. And somehow investors who haven't seen the bottom cycles of 2008-9, as well as the the burst of the IT boom, they can't comprehend the pain that you would go through when there is a real contraction.
Of course, sir. But that's
Yes,
the
so
nature of the market. Bull
yes.
and the bear market, they always coexist. When the bull markets are on, we enjoy the joyride.
Yes.
When the bear market hits you,
Yes.
that's more like a reality check. So let's talk about your current positioning.
Yes.
In the funds you manage, in the money you've raised, how have you invested it?
So in this year, just because of the discomfort with the valuations, we have exited a lot of companies. The companies like the consumption oriented, the NBFCs, where we have been holding positions for the last 3 to 5 years, we have exited mainly because of valuations. And see, it's not that we expect too much correction in the market, but it's more that we have a list of stocks where we are really interested in. And we think that we would get an opportunity to get into those stocks, which are trading at much attractive valuations. And to keep that dry powder, we have maintained some cash positions. So we are, 25 to 30% in cash. And mainly that is a dry powder that we need when there is panic in the market. So, the sentiments in the market are so short-lived. Sometimes people think quarterly. If there is one bad quarter, I think there could be panic in the market and we could get the prices that we look for. I don't expect like the Nifty would correct, because the setup of Nifty is very different than the small cap and the mid caps. But there are pockets in the market which may be impacted short term. But in the long run, because of the step that the government has taken, I think the potential for those businesses, I think they have gone up multiple folds. So we are looking for such businesses where there would be short term pain, but in the long run, I think they are better positioned than they were 3 months back.
So give me an example of what is there on your radar. You've told me what you've sold, but I'm inclined to understand what you own and what is there on your radar, because money is made not in analyzing past. Money is made by predicting future or trying to understand future.
Yes. So the kind of sectors that we like, where the valuations are in our favor, is like branded building materials.
Okay.
So I'm not looking at the commodity building materials, but branded building materials where the unorganized sector is pretty large.
So tile companies, paint companies, and to some large extent plywood companies.
Right, those kind of places. But again, you got to look at, each company individually, where the competition is weak,
Okay.
and how the strategy of those companies are. I mean, in the past also, we have never been able to play on themes, but we have been able to play on the bottoms of stock picks, where the competition has been weak. I mean, look at the example of Bajaj Finance. In 2010, the international players like Deutsche Bank, Barclays, they had gone out of the market because of their 2008 experience, and you had no competition in that space. And when you do your ground research, you visit the malls and you look at the processing time of these companies. The competition was Future Retail, Reliance Capital. They used to take 1 or 2 days, to get back to you on your lending, whereas Bajaj Finance used to do in a matter of few minutes. So that shows you the competition has gone away. The big competition has gone away. The remaining competition is not in a position to take advantage of the vacuum which has been created, and you take advantage of that.
So where else do you think this kind of an opportunity is getting created in this current scenario?
So I think that's one, and auto ancillary, because with digitization which is coming in, I think it's going to be fast forwarded because of the step that the government has taken now. And with that, most of the people, even in the rural area, are going to be connected, with your
Mass transport.
And that is going to fast forward the move towards buying online. And if you want to buy online, there are very few places that you can probably go for because they are mostly unlisted. But it's a space which is of real interest to us. So I think the indirect way of playing that is either through a two-wheelers, because that's where the last mile logistics
That's a third derivative. I mean, if you're betting on e-commerce, why not buy a data company, or why not even buy a company which is in logistics, or why not buy a company which is making corrugated fiber? to capitalize on e-commerce boom via two-wheelers, some would say that, look, that's like a stretch because two-wheelers have their own unique set of problems.
See, I mean, whenever we invest, we don't want to bet on just one trigger.
Okay.
We want a company to be, for example, when we bet on Amara Raja, it wasn't just the auto, but they were getting into, the UPS, they were getting the telecom batteries. So you want multiple triggers, or else you increase the risk of your investment. And that's where I think the two-wheeler, there are multiple drivers which will drive the growth of the two-wheelers. Even if the e-commerce doesn't work out, you don't want your investment to fail. And that's where I think instead of playing on the two-wheelers, which is again a branded play, and you don't know which model would work, go for the...
So you are bullish on companies, or you're bullish on auto ancillary companies which are supplying parts to two-wheeler companies. Let me put it this way.
Exactly.
Okay.
So either two-wheelers or the low-end, four-wheelers, because I think that's where the market is. India is, I think the move of rural to semi-urban, that's have driven the volume of two-wheelers and low-ended four-wheelers. And I think there are many more triggers which are coming up which would help the kind of growth that we have already seen. And the valuations there are not at all stretched. You will get a lot of these auto ancillary players at 13, 14, 15 multiples, which is almost half the valuation that you would see in the small and mid cap.
If valuations don't fulfill your criteria, you will press the sell button. You don't buying in marrying stocks for eternity. Like Buffett says that their consumer franchise, I will not sell them. They may look expensive for 1 year, they may look expensive for 3-4 years, but the business itself was so great that eventually they will even out.
Again, it's depends on what the aspiration of my returns are.
Okay.
My return expectations are 25%.
Okay.
If that is my expectations, I can't invest in. So you need support from good business as well as support from really attractive valuations. If you
it's hard to get that combination in this market.
Exactly. I mean, if you were to aspire to make 13-15%, that's the easiest way. You just invest in an iShares, you invest in a Page, you invest in an HDFC Bank, and make a portfolio of a dozen stocks. And there's no need to struggle. But when you move your aspirations from 15% to 25% or 26%, that's 10x difference and difficult. Imagine, 15% compounding over a 40 years investment life gives you 267 times.
Yeah, we all know the rule of 72,
right.
The power of compounding.
And 26% is 10,000 times. That's the power of compounding. So it is that much difficult to generate that 26% return. So for that reason, if valuation is not in the comfort zone, we do not marry the stock for our lifetime.
Which is one stock you bought it when you launched your fund and you have plans to keep it for next 5 years? You like the business or you like the company so much that you would say, look, I'll ignore the short-term underperformance, but this business and this promoter and this company is for keeps.
Right. So, we own one specialty chemical company where the valuation is still not of 30, but they probably are, closer to the low 20s. But again, the potential of that business is not just India, but global. And they're the one-off companies where there are multiple competitors who have tried to come into that business and they haven't been successful. So we look for, such difference in the competitiveness of the companies. And that's where, you find that, and that competitiveness is still existing. The valuations are in the decent, comfortable level.
Is it an agri-specialty chemical? Is it industrial specialty chemical? I respect your compliance.
Yes.
But for our viewers, we need to understand your thought process. So can you just throw more light on this specialty chemical position of yours?
Yes. So it's an agri-specialty chemicals. Okay. They are getting into the pharma specialty chemicals business, and the size there is pretty large. Okay. One company like a Bayer or Dow Chemicals, their potential of outsourcing the contract manufacturing is basically $1 billion. This company is not even reached that stage, and they have probably 15 to 20 such customers they can cater to. So I think it's just the start of the cycle for them. There is a long way, and then the next key is the management. The focus of the management. They don't have any other divergence. Their entire focus is this business and we like such focused businesses and managements.
What is the view on IT? Because some would argue that IT is also a very focused business. From IT promoters, at least the old promoters, they don't have multiple businesses. They only run one company with the intent of scaling it up. IT unfortunately is contracting, but these are great businesses, solid return on capital. You know, there's cash on the balance sheet. Are you hunting, or are you hunting there? Are you fishing in that pond?
So again, as I said, our aspiration is to make 25% returns, and we do a lot of data crunching, and we are really data oriented, and we look at the kind of sectors which probably would give us those kind of returns. And so the analogy that I always give is that if you are looking for marathon runners, you better know which are the countries to look at. There are 200 countries in the world, and there are probably 2-3 countries where you need to focus on to get a marathon winner. So I would rather focus on a Kenya or a Ethiopia, and then eliminate most of the other countries. So that's what we do. We don't spend our time analyzing industries where we know that it's a stretch to get 25% kind of a return. Again, if your expectations of making returns is 12 to 15%, IT might be a good business, because it gives you a good valuations right now. The growth is moderating, and maybe it's so much a safer business, but it's not a space where we have ever invested, and I don't
even
see
mid-cap IT.
We haven't yet.
Best gains are always made, and when I've spoken to great investors, is that you always tend to buy little bit of fear and little bit of mispricing. Markets believe that the business is going through a cyclical downturn. That's the time quality business that gets mispriced, and that's the time you should buy. So where is that thesis applicable? Where a good quality business, because of demonetization, because of FI selling, is suddenly attractive?
I think building materials, branded building, because I think what's happening is that the unorganized sector, a lot of their plants are shut. The dealers are facing cash crunch, so they are not going to pay the manufacturer. So I think the working capital cycle of a lot of these, even the branded players, is going to get stretched. And because of that, they won't ship out new products. So I think their earnings would be significantly impacted over the next couple of quarters. And that's where the opportunity is. If you look at the long term, these are the players who, I think it's the process has now fast forwarded, where the move from unorganized to organized is happening. So I think their competitiveness will significantly go up. There was such a pricing pressure because of the tax arbitrage of these unorganized players, that because of now the consolidation, a lot of these unorganized players would become the contract manufacturer for the organized players. And it's almost like a consolidation of the industry, and where generally the surviving players get the pricing power. I think that's what would happen, and that's where the profitability as well as the growth would go up. Yes.
And if you have to, let's say, construct a portfolio as of now, December 2016, you would say that building material is one space where there is opportunity. There is a little bit of
auto,
margin of safety, which is an auto ancillary. Anything else which is there on your radar which fits your criteria?
So I think the agri space again. So where I think the finances, once the government finances improve, the funding to that space would improve. Working capital has been the biggest issue in that space. At the same time, the insurance for the farmers is going to help farmer take more risk. So I think the volume probably also would go up. So higher growth, at the same time improving profitability, is a space, and they are trading at really good valuations, and a lot of them are available at single-digit P multiples. So I think that's a space where I think there is no option for the government but to spend money on the rural economy, and I think that's a space which will benefit the most.
You would still shy away from buying commodities and commodity related businesses, because my sense of the commodity cycle is that a new cycle has started. Last couple of years we've seen contraction in inventory. Now data is indicating that inventory cycle could be starting again. So if a new inventory cycle in the commodity market started, it could be a fresh beginning for the commodity and commodity related businesses.
Absolutely. It's just that I think a lot of time commodity plays are tactical plays, where you need to get at the right time, and exit at the right time.
So you would trade in commodity stocks. You would rent those stocks. You will not marry those stocks.
Right. So if we find that kind of, as I said, for the 10%, if we find that 40-50% kind of a return in a matter of few months, huge trigger and really attractive valuation, only then it would be a really tactical play. But for our core portfolio, which is 90%, we would not think of commodity stocks.
So let me get some closing comments from you. And typically, if you look at good businesses, they have to have a entry barrier. They have to have a little bit of pricing power. And these businesses, too many of these businesses don't exist in the B2B category. They exist in B2C category, or you have to have some intellectual property about that business. A lot of consumer stocks are expensive. A lot of intellectual property businesses, which is pharma and specialty chemical, they are going through their own cyclical churn. So where is opportunity in this market? Because the way you invest is that you like to buy future earning with some pricing power. And I'm really struggling to think of those names.
Yes, so I think the kind of stocks that we look for, they need a couple of enablers. One enabler is you got to take market share away from weak competition. Second is you got to enter into newer and newer businesses or industries where you cater your product to. I think because of GST and the kind of steps that the government is taking, India has had huge barriers because of high asset prices, which is land prices, as well as high interest rates.
Yep.
With the borders, the state borders going away because of the GST implementation, I think India is going to be a very competitive market for manufacturing. And there are certain companies in the textile space, and also it could be auto ancillary place, specialty chemical space, where India would take market share away from, in textiles, it would take market share away from Pakistan, from Bangladesh. China is a huge market for textile. I think we are very competitive, and once you take away these hurdles, we would become very competitive. I think that's where we would get pricing power. So we would be able to make, I think the next investment is going to be much more profitable than the historical investment. You need that. Secondly, because of, I think the textile space right now is just focusing on, say, one bed linen. They are getting into, from bed linen into fashion linen, into the curtains.
So do you own textile exporters?
We do. Yes.
Couple of them, at least. There are 2-3 of them. So you own one of those prominent names.
Yes. Okay. Yes. So again, we don't want to focus on.
You're not worried after the Welspun experience?
So, after the Welspun experience, I visited New York. I visited 2 or 3 showrooms, in New York, where, there is a textile building in there, and spoke to some of the designers out there. What exactly was the issue? And post that, got a lot of comfort. I think the issue is history. Going forward, most of these companies have stopped selling Egyptian cotton, and I think that was very small market. It was, for most companies, it was single-digit market share out of the total.
It wasn't much.
So I think that's history, and you got to focus on players where they are not focusing on the manufacturing of, because there are a lot of incentives on integrated plants, from the government, and that benefits the promoter more than the shareholders. You want to focus on companies where they're focusing on brand building, they're focusing on developing relationships with the large store formats, and they're focusing on the product. So that's a sense you only get once you go to the showrooms and see how their designs are, what kind of brands, what is the feedback you get from the designers as well as the competition. So I think we are at a pivotal point there where, as I said, Indian companies would take market share away from the Chinese player. I mean, again, there is one more trigger which is possible. We do not have an FTA with Europe. Right?
Closing comments now. Last couple of years, for those who've run a consumer-facing portfolio, whether it is brands, consumer names, staples, consumer-facing NBFCs like Bajaj Finance, they've outperformed. Yeah. Next 3-4 years, do you think that may not be the order, or still consumer-facing businesses will do well?
I think, again, if you're aspiring to make 25% plus, only if the valuation is correct. You can't make 25-26% over the next 5 years if the valuations is not in your favor. NBFCs trading at 4 times, 5 times, 6 times definitely is on the higher side of comfort. Consumption plays trading at 40, 50 times is not.
Because if entry price is great, then only your exit price is going to be rewarding.
Exactly.
Really appreciate your time. You're planning another fund, so good luck for that.
Thank you
good
so
luck
much.
For 2017, and certainly hope to see much more of you going forward.
My pleasure.
That's it on this edition of Market Makers. Thank you for tuning in, and thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.